Good afternoon and good morning for our colleagues and even our guests in the US and all over the world. Good afternoon, everyone from Dubai, United Arab Emirates. It's my pleasure to welcome you to the second Posterity Fireside Series conversation, where I host an expert to uncover their views and perspectives on emerging topics. As you all know, the pandemic hit the economic sector really hard and left us all with a financial burden of achieving our sustainability goals. We have enough tangible evidence to prove that sustainable finance strategies are our way out of the COVID-19 economic crisis and the climate crisis pandemics as well. It's actually the lifeline and best practice moving forward. Given the stakes of these pandemics, investors around the world have increased their focus on sustainable and risk-free businesses. Companies are proving their forward-thinking and limited liability economically and environmentally to attract investors. They do that through solidifying and prioritizing environmental, social, and governance aspects, what we refer to as ESG. Today, we will be discussing how investments in emerging markets can impact the climate crisis. We will also be sharing insights on the role of investment institutions in accelerating national and global climate action, key trends in innovating financing, and key investment opportunities in emerging markets. I would like to kick off this series with Dr. Ekaterina Gratcheva, Dr. Katya, the lead finance officer of Climate Investment Funds. Dr. Katya has recently joined Climate Investment Funds to lead its finance function and scaling up resource mobilization from private sector to finance transformational change towards low carbon climate resilient development in developing countries. I hope I've said everything this in one word and well. It's a huge role. In her prior roles in the World Bank, Treasury and Finance, Competitiveness and Innovation, Global Practice, Dr. Katya focused on providing policy advice and thought leadership on sustainable finance, facilitating long-term finance through capital markets, and strengthening the role of financial institutions in development finance, as well as on managing World Bank assets and liability. Welcome, Dr. Katya, and we are so lucky to have you with us. And good morning. I know it's 8:34 in Washington, D.C. And I'm sure, as you've mentioned before we start the live transmission, you've been enjoying the autumn weather, the autumn season, which is great, which is something some of us miss maybe in this part of the world. But I would like first you to share your thoughts on the challenges of funding and securing investments in the emerging markets of today. Thank you, Dr. Katya. Go ahead.
Thank you very much, and it's a pleasure and privilege to be here and talking to the audience and share our thoughts and experience of where we are in climate investment funds. And before we deep dive into how climate investment funds are scaling up, given, as you mentioned, the challenges that were particularly revealed by the ongoing COVID pandemic, let me set the stage from my also prior experience of how the financial system has evolved. And pandemic only accelerated the trends that have started prior to that. And it revealed maybe perhaps even more pressing needs to continue to evolve financial system. As you said, without financial system actually getting implementing sustainability in its decision making, it would be very difficult for us as a society to achieve the objectives that we need to achieve to avert crises such as pandemic, climate change, and other factors. So let me step back a couple of steps where, and I've been in the industry, in the finance industry, as a practitioner for 20 years. And so I've seen firsthand how finance has been changing. And the change of pace has been accelerating. And the catalyst, important catalyst, had been the signing of the SDG goals, Sustainable Development Goals, in 2015, and the Paris Agreement in 2015. It became quite an important year in the evolution. And for the first time, the finance industry had been represented in those discussions. Before, the development discussions had been focusing mostly on policymakers. And for the first time, it became quite evident that finance is not only a necessary source for the transformation, but it's also an important partner for a number of reasons that we will deep dive into once we start the discussion. So 2015 became quite an important role, sort of pivotal point. After that, and the political change happened in the US administration that had put some challenges on the political landscape. Having said that, there had been that accelerated the interest of financial sector to play even more pivotal role, to compensate for any particular policy delays that they were perceiving of not meeting pressing needs in the space of climate change and sustainability. Globally, there had been a lot of emergence of different coalitions and memberships, whether it's in the policy sector, such as most notably Network for Greening of the Financial Sector, or NGFS, in 2016, which currently has 95 members and 15 observers, which is a coalition of central banks and regulators. And then the Coalition of Finance Ministers for Climate Actions, more recently in 2019, that now counts over 60 countries. And all of them are now also expediting the regulatory focus to accelerate the green transition and facilitating what the financial sector has started to do. As you also mentioned, there had been quite a focus on ESG, and the immediate reaction from the financial sector has been to pursue new strategies, such as low carbon strategy, lots of divestment from hydrocarbon sectors, also active engagement, both the equity owners as well as the bond investors on various issues with investments on sustainability, etc. And the financial architecture has also evolved with the emergence of the new sector of ESG providers that started to provide relevant data, advisory services, analytic on climate and broader issues of sustainability, portfolio monitoring. Bond principles have emerged, and it became a multi-billion-dollar industry that has now become quite an integral part in the decision-making. All of this has been a very positive and quite measurable impact on the financial industry as a whole. This is the good news. The not so good news is that it impacted emerging markets disproportionately, and on a number of World Bank-led studies, it created some perverse incentives for institutional investors to divert capital, already scarce capital, to emerging markets away from the low-income countries towards more wealthier countries. Why is that happening? At the sovereign level, ESG scores, when we analyze them, measure, I explained 90% by the country's level of development, which means the countries have been almost penalized by how they assessed in terms of ESG scoring for being poor rather than for their good policies. That's something that the financial industry hasn't quite been aware of until World Bank came out with the studies and started to engage with the investors. The other challenge for emerging markets is their a very low level of development of the capital market. So they are relying on that capital to flow, yet they are not frequent issuer in the capital market in terms of bonds. And we can discuss a little bit more how that affects in terms of their ability and willingness to issue green bonds to fund their green activities. They also don't have the capital markets for investors to go into the corporate bonds or equity markets. So there is quite a challenge, even for those investors that are willing to finance transformative projects, to do the selection of relevant instruments that would fit into the investment processes, investment decision making. And this is where SIF comes in, and we can discuss a little bit more on it in the discussion. Is SIF has been providing this instrument that taps into existing infrastructure of multilateral development banks that are already present and have been present, let's say in the case of IBRD, International Bank for Reconstruction and Development, of 75 years on the ground, so understands the challenges of implementing and preparing investment in emerging markets. And it builds on the existing know-how and soft and hard infrastructure to invest in emerging market countries. It also is engaging quite actively with the public sector and the private sector to address some of those perverse incentives that sustainable finance has created and further disadvantages emerging market from access to capital market. And SIF has been evolving with the needs of financial markets, and we can discuss more the details. Probably the audience had seen recent G7 announcement that the G7 members have agreed to called for SIF to continue playing an important role and scale up its role, and committed 2 billion in additional capital for us to do that. In terms of background, in terms of SIF Climate Investment Fund was established as a G8 initiative in 2008 with the public capital of 8 billion. And since then, it has deployed, it has mobilized and deployed nearly 60 billion in emerging market countries across a number of technologies, clean technologies, renewable energy, energy efficiency, sustainable transport, adaptation and resilience, sustainable forestry, and energy access. And we now have been engaging with the donors in the market on new programs because there is many of the sectors in which SIF has been investing from its establishment have become commercially viable, and the private sector is already investing in bankable projects, particularly on energy efficiency. And we are going into the sectors that still require concessional funding and require more holistic approach. I think most notable of those programs are accelerated coal transition and renewable energy integrations. That is quite challenging for the private sector to undertake, and our sort of approach, integrated approach, holistic approach with public and private sector and multilateral sector partnerships is what has been interesting for our shareholders, the G7 and other donors to engage in. I think that probably sets the scene of where we are in our evolution, and happy to pick up on any of the points with you.
Thank you, Dr. Katya. I have a lot of information. Thank you so much. And I think it's, first of all, it's good to know that there is a platform for such investment in sustainable finance and in emerging markets. I believe you mentioned 60 billion, which is that's a great number. But this brings me actually to my first question. And now the whole world is talking about COP26 and the reference to COP21. So how can we accelerate achieving the Paris Agreement and finance goals in emerging markets? What can the role of green bonds and innovative financing in general be?
That's an excellent question. And I think it's already a consensus that relying on public capital as alone, as has been predominant a driver for concessional finance in frontier markets, in frontier technologies up to now, is not sufficient. While we talking about 60 billion, that we have been able to deploy, the needs are in trillions, and for us to make tangible efforts in actually tackling and getting on track with the climate trajectory. And as COVID exposed, the public sector is facing scarcity in fiscal resources. But that's not the sole reason why we need to rely on private sector, because the private sector also brings expertise, scale of finance, and it is in the partnerships that sustainable and transformational solutions that emerge. So we can't do it alone. And I think emergence of all the different platforms and coalitions, whether it's on investment base or others, is an important part. You asking about green bonds, and it has been an incredible transformation in the market. And the first green bond was issued by the World Bank 12 years ago, and I was quite fortunate to be at the time in the World Bank Treasury to see how the cooking side, the kitchen side of that. It was also quite what seemed quite an impossible transformation then, because of the challenges of putting it together. You put the environmentalists in the room and you put the finance people in the room, and they speak two different languages. Right now, it became, if you look at it from all the announcement and all the celebrations of the growth of that market, had become a mainstream product. Having said that, perhaps very few people understand that with all the growth and all the celebration and all of the publicity that they get in, green bonds are just 1% of the outstanding bond amounts. And the growth is in green bonds is by far superseded by the growth in non-green bonds. If you look at the green bonds in the emerging market economies, the situation is even more challenging. So if you look at, I think there have been 22 issuers to date, sovereign issuers to date on the green bonds. By far majority of them are developed countries, European nations in particular. For emerging countries, if you take out Chile, which has really transformed the issuance program and predominantly issues large green issuances, what's left is a tiny, small, discrete issuance in the lower or low middle income countries for a number of reasons. And we have another World Bank study that looks at, is the green bond even the appropriate instrument for emerging markets? And the number is not the answer is not necessarily. We have a quite detailed study that looks at all the other options for emerging market countries to see if they want to take advantage of the transformation in the financial industry and capitalize on growing awareness in the ESG. Green bond is one of the instruments, but perhaps not at the stage where developing the low middle income countries are. So there is a number of policy issues, technical issues that have prevented the emerging markets of tapping this part of the growth market. And I think that brings me to a very important point that I want to highlight, and perhaps there is not as much awareness as we would like, and we engage with the private sector on this. The needs and challenges of sustainable finance in developed markets are very different from emerging markets. And the dialogue of investors, institutional investors, or NGFS or other platforms quite often focus on the needs and implications of countries rich with capital. And that conversation quite often is not factoring in a very different realities of emerging markets and the ability of accessing capital market. It goes back to my earlier comments, is that while capital market has been growing and the bond market is $120 trillion market, in the case of emerging markets, they're facing significant barriers to enter that market and benefit from the current evolution. That's why I was particularly excited to join SIF recently, as you said, this year, is to really try to break those barriers, to address those barriers, because obviously the aspirations on the public sector, on the financial industry to address them as high, but we're facing some structural challenges that we all have been working together to mobilize that capital for emerging markets.
Thank you, Dr. Katya. You've mentioned about the green bonds or green sukuk. In our region, Dubai-based in Majid Al Futtaim, we issued the first benchmark for green sukuk, which is a Sharia compliance plus it's a green. We also just finished a transaction for sustainability-linked loan, but I may come back to about what is the best thing for the region, but maybe the second question I'm going to ask may help of giving us some clarity about where to put the money. Do you think we should attract, or how, if green bonds not necessarily green bonds is one of the solutions for the emerging markets, how can we attract then more national and global investments to the climate tech sector in emerging markets? This is a sector with technology for good, AI, but climate tech related to climate change. Also, if we want to do that, what do you see the role of the of public collaboration?
I think the emerging market countries are not homogeneous, right? They're quite different, and yes, Middle absolutely. East has been perhaps quite fortunate in its own natural resources that helped the development and provide some cushion to think of more innovative solutions to scale its investment in climate tech sector. Many other countries in emerging market countries don't have necessarily that, and they are poor in both access to capital and underlying assets, the national assets that they can tap into to mobilize that. The challenge that we are seeing in the countries is and from bringing, let's say, private capital into this discussion, is the perhaps right and misperceived risks on the ground of emerging market countries. So there is a heightened aversion to facing the markets where it's perhaps not as well understood, because it's not institutional investors not necessarily have offices there, not necessarily understanding things on the ground. And there are obviously real risks that we all see in terms of how those investments behave, but there are also perceived risks. So there needs to be effort on both of those sides. The second thing is some of the technologies that you mentioned are frontier technologies. They are lacking a particular track record or data that has become so fundamental in the sustainable finance industry for the industry to go into new sectors, into new markets. They want to have evidence-based decision-making. They want to understand the risk that they're facing and the impact that they will have. And that becomes quite often a deterrent, as perhaps the data is not of high quality. There is a lot of discussions how to address it. The World Bank broadly is dealing with these issues as well. And as we discussed, there is not as many opportunities in terms of investment products to invest in that. And what SIF has been doing is to build that, to provide that platform where at least those two aspects have been addressed. Since we have presence on the ground from the World Bank Group offices, and we work with 6 multilateral banks as our implementing agency, we understand those markets, we're present in those markets, and we can engage with private sector and public sector to explain better, even when there is no hard evidence, hard data, on what kinds of risk our investors will be facing. And we are providing also the instruments through co-investment with MDBs that are doing this for their own balance sheets. And they're AAA rated institutions. So they go into these markets with their eyes open, understanding what they are investing in. And because they have to go back to our risk committees, they have to go back to the board, and the board will be looking at it through the perspective of how does that contribute to us maintaining our credit worthiness, because that's one of the sources of why we're able to provide, we MDBs collectively able to provide concessional finance to those countries. And that becomes a platform for bringing in additional investors from the private sector to co-invest and take the type of part in the structure that meets their needs.
Okay, well, I'm going to ask a question, then I may open it up for the audience if they want to ask something, but I will come back with a couple of points. But in general, like, because I agree with you about the data. They don't have data track record for climate tech sector. But what are some of the investment opportunities that you think emerging markets can capitalize on post COVID-19?
I think it's a tricky question to sift because because that question is asked with very different objectives in mind. Whether you're a commercial investor and you want to go to the market with the idea of generating commercial returns based on your investment objectives and your fiduciary responsibilities. For SIF, our objective is transformational change. And we go into the markets knowing that we are facing additional risks. We are backed by public sector. We are deploying concessional funding. And our objective is the maximum impact. And so for us, we are evolving with the market and the market needs, and we are preceding the private sector. As I mentioned, for example, energy efficiency, SIF was one of the first ones to go into the sector until it became commercially viable for the private sector to do it alone. We quite often go on the ground to take the kinds of opportunities that perhaps are not seen as opportunities for the private sector unless they want to co-invest and participate in a sort of concessional investment opportunities until they're ready to do it alone when this becomes more sustainable. What became quite, what we're hearing and what we're working on with our donors, and we have a board meeting in October that we're bringing this to, is in particular two highly program that are highly demanded by both, have resonated with the private sector and are what our donors are quite keen for us to proceed. And I mentioned them. It's renewable energy integration of transforming energy systems within the countries. It's not a commercially viable yet and requires quite a lot of experimenting by doing and more holistic approach. It's not just about investment, but policy transformations and addressing other barriers to it and accelerated coal transition. And I think accelerated coal transition, so all of them, the programs that we are currently working on, they are quite attractive to our stakeholders because they're taking us closer to the net zero pathway and addresses some of these issues. And they are suitable investors for us. And we would love to bring in private sector along with us. But if your question is, how can private sector see what is the emerging sort of technologies in the private sector that they can invest in the commercial sector, there is perhaps a different answer would be to that question.
Okay, I will accept that because you just said it's a tricky question, but you know what, I'm gonna, if you don't mind, I can see some questions there. Let me open it up for Megan. Hello, Dr. Ekaterina, and thank you very much for the insightful presentation. Can you tell us how we can couple green investments with a just transition in emerging markets? So can you tell us how we can couple green investments with a just transition in emerging markets? This is from Megan Rantous.
It's a very important question, and I think it builds quite well from our this previous discussion. And when I was mentioning what's the opportunities for investments to Mr. Ibrahim question, and then I said it's a tricky question, it's exactly the reason why it's a tricky question. It's the integration of the just transition. And I think as an example that perhaps was quite evident is the movement of yellow vests in France that became quite evident, that moving into zero carbon economies it's not about making rash decisions, but it's making sustainable structural changes in the process. And as a result, our accelerated coal transition and renewable energy investment are looking at this integrated approach that tackles a number of different aspects of what it means for a just transition. It looks at different policy barriers. It looks at financial instruments. It looks at how what happened with the sort of on the social side, talking about S of ESG during this transition. Let's say we're decommissioning the coal plants. What happens with the industry? What happens with those employees? So I think it's a prerequisite now. Yeah. If we are, and this is perhaps the key differentiator in terms of opportunities. If we looking at short-term investment opportunity, you have one set of investments. If you're looking for structural change and long-lasting change, just transition has to be an integral part of the decision-making and structuring that investment. And we see in it how difficult that is now that we are engaging with a couple of very large sovereigns on their plans for coal transition. And we don't even have a consensus within the policymakers in those countries of what that means. So it does require multi-stakeholder approach, and it does require the countries that are sponsoring these types of investments to have a very active dialogue in the policy design of these types of investments.
Thank you, Dr. Katya. We have a question from an anonymous attendee. What is your #1 advice for sustainable startups who are struggling to manage in a post-COVID-19 world? I think this question is for Dr. Katya, not for Seth. What's your #1 advice, or what's your advice? I'll make it easier for you.
my advice. Well, I think it would be very interesting to understand maybe a little bit more what is the struggle about and what the business is about. I think, and if you want to provide a little bit more information about this, it's very hard to do a generic advice. I think what COVID revealed is that it tests business models. And I'm in a family that runs different businesses that have been affected by COVID. And now I'm speaking not as a chief employee, of somebody who has been part of the observing how people reacted who run their own businesses to the challenging environment. And from what I've seen, what works is sort of the agility and decision making, is not to get too attached to the notion and the design that went into the business before the COVID struck, but to have a flexible mind and the risk-taking tolerance to be willing to experiment and to test whether in a post-COVID world this is a sustainable business model. We are not going back to the pre-COVID times.
No,
The world will be different going forward.
Yeah.
Very few know how it will evolve, but I think what became quite evident is that the agility, open-mindedness, ability to fail and fail fast, and then move forward with the new ways and more experiment-based approach, I think is what would be required for businesses going forward in a post-COVID world, because we are not facing another windfall stable time in the foreseeable future. There is too many risks and the heightened awareness of future pandemics, of climate impacts, etc., that to suggest that we need to be a lot more nimble in assessing what works and what doesn't, and be willing to walk away from something that doesn't work.
Yeah, I agree. So we have one more question from the audience. Can you tell us more about a project that you worked on that you are proud of? You are very proud of, to be fair.
That became less of a SIF discussion, but more as my Katya Gratcheva's career journey.
That's why this is an informal discussion.
It's an informal discussion.
Yes.
And I think what brought me to the World Bank group in the first place and is the possibility of transformation. My skills were sufficient for me to go to the private sector financial industry, and I studied in the trading floor of the World Bank Treasury, and I could have been on the trading floor of any private sector institution. But having grown up in the Soviet Union and seen the collapse of the Soviet Union, I think it ingrained in me the need for transformation and to having a positive impact in this. And I think what's my career in the World Bank, and SIF is a part of the Secretariat for SIF is hosted at the World Bank, has been this constant ability to evolve and to continue to apply different skills for the transformational impact. I'm super excited I've been part of SIF, because I think it's not something that I yet can claim as my impact, but I think we are making incredible progress in transforming and helping to transform financial industry, and I think that would have an important impact in making more scaled up investments in the climate finance. In my earlier parts of my career, in prior roles, I was fortunate enough to work in 90 countries, work with their governments, and I've worked with large governments, with small governments, and perhaps for the same reason as to see in the measurable impact. I appreciated working in the small countries, small economies, where my efforts to help them, let's say, improve management on their natural resources.
Which country? I'm intrigued to know one of them.
Well,
one of the countries that you
I worked quite a lot with sovereign wealth funds, And you would be surprised that one of the longest surviving sovereign wealth funds are housed in a very small country that people perhaps don't even know the name, which is Kiribati. It's a small island in the Pacific. And it's one of the few, probably the only fund that has survived after it has been funded through phosphate exploration that has since been depleted. And the country's set up its sovereign wealth funds in the 50s and has now grown to be 400% of this GDP. And it had become one of the most important sources of finance for development. And this is the country that has no access to capital market, that has no market to global access to global markets. And for them, and it's at the bottom of the human development income and GDP, you would see that would have such a challenge for them to even manage such sophisticated instrument as sovereign wealth fund. And I've helped them to make it sustainable and transform it, and that has and they thrive with this. I think this is something that I'm very proud of. I have been engaged in discussions in the Middle East. I have been engaged in African countries that are, especially in Africa in the last decade, there had been significant exploration, discovery of oil and gas reserves. And help them think, in the time of climate change, should they leave those reserves underground? But having all these challenges of access to capital market, that's perhaps the easiest way for them to mobilize, to extract that so that they can rely on finance for their development needs, or be member of sort of an international community that wants the oil to be left underground. And it's a very challenging discussion for policymakers to have. You have this asset, you can monetize it, yet it contributes to something that makes the development much more challenging. So those are the types of projects that were very meaningful, very impactful, and they also have been very challenging and stimulating intellectually, engaged in a number of different stakeholders, public, private, civil society, on the ground policymakers, decision makers to engage with. I think that these are the most fulfilling parts of my career to date.
Very nice. Okay, we have a comment from Afaf. Great discussion. Thank you. We have a question. How can market participants overcome challenges that arise from their sovereign context when they adapt the ESG framework?
That they can overcome sovereign ESG issues that I mentioned? Is that the question?
The question is, how can overcome challenges that arise from their sovereign context when they adapt the ESG framework?
When they adapt the ESG framework. I think if this question is from the perspective from emerging market country, and how to tap into the ESG capital that is available, I think we would be happy to share the report that we've produced on this. What's important to understand at the emerging market level is that the market needs right now requires incredible amount of transparency, an incredible amount of disclosure from sovereigns. We've working in my previous role, we were working with the debt management offices, which often become the entry of point for institutional investors to understand the country's policies on ESG, because a lot of this information is not publicly available, or not even available in a format or in a way that financial market consumes. And so what became, as I mentioned, quite prevalent for investors to do is the true engagement. And while engagement has been quite active at the corporate level, at the sovereign level, with the ministries of finance, with different line industries, Ministry of Environment, and debt management offices is a much newer experience. And I think what everybody is doing, both the debt management offices on the ground and institutional investors, are coming with the frameworks of how to make those discussions systematic. And even before issuing green bonds, I think investing in the capacity of the country to showcase its policies, to provide engagement with the investors. And there is a number of publications where we discuss how this could be done, what areas are of interest to investors, and to really invest in that capacity, in data gathering, in transformation, and the right messaging that resonates with the institutional investors. Again, what I have seen in my entire career in the industry, you have different stakeholders looking at the same data and interpret it differently. So it's important to understand each other's perspective, and important to understand, yeah, this is the data that I need to make available, but how would I need to package it in a way that it would be consumed in a way that benefits me? And would be happy to share all of these resources that get into these issues in a lot more detail for references, that we discuss a number of different strategies to tackle this issue.
Yeah, actually, that will be great. I think we can email back the participants with our thank you email. It will be good to give them some references to the resources you've mentioned. I have a long question here. The World Bank has shown that responsible investment has high returns in low and middle income countries, $4 for every $1 invested. On the other side, continuous investment in low resilient infrastructure assets would cost countries $1 trillion in the next decade. What are your recommendations to stimulate investments in the right direction in emerging markets? This is from an anonymous attendee.
I think this is what the World Bank is doing, is to show the way of how to do this. I think we tackled this issue in a number of different ways, in helping the industry understand the impact of them being focusing on short-term consideration versus long-term, which we called short-termism versus long-termism. And quite often they're not doing it out of malice or ill intent, but quite often low resilient infrastructure investments come from the expediency and because it's perhaps easier to put together. It's status quo. It's how the world has always done it. To change requires a lot of investment. It takes a lot of time. It takes cost. It takes understanding. So we at the World Bank is trying to address a number of these issues that increases awareness. That's what is the long-term cost of short-term decisions, as you outlined, that they having low resilient infrastructure will cost the same investors and the world in the same place. I think another important discussion that I think has changed, and the conversation has changed tremendously. There is a lot more willingness to listen and to engage in the sorts of discussions. I think there is now awareness that we are all in it together. There is no longer, oh, I have my bottom line and profit bottom line, but there is no benefit of preserving your assets because you generated high return in a world that it's on fire. And so I think it's changing minds and hearts and providing tools to do the right thing is what we see from my perspective as what's needed. And I think the discussion that we focused on today, how the financial industry had evolved and how all different partners started to come together on the sorts of issues, highlighted there is a willingness and openness to do the right thing. And we all experimenting is with how. I think what needs to happen, I think there is emergent consensus or emerged consensus that the long-term investments pay in the longer run. I think what's the challenge for all of us collectively is the how. And we're at SIF is what we're doing it, and we are sort of, I guess that's provides us, and maybe that's another resource we can share with the participants is we are sort of a finance climate learning academy. We can afford to test new ways. And we have a learning academy on a number of different case studies that we publish on green recovery, on development impact of different investments, on sort of transformational change of different investment, just transition, which was asked before. And I think we have quite a lot of learning that has now become in greater demand for the financial industry, because we go where other investors are yet hesitating to go. But with the better awareness and better willingness, I think this provides sort of not necessarily full paved roadmap, but insights as to what can happen when you make different decisions on different investments.
I really like what you mentioned about discussing the how, and I think that's important now, even before like COP26. In the last 2 years, in the last year alone, we've seen more than 300 companies committing to net zero. We've seen countries committing to net zero, but the backlash now, I've read an article in the Financial Times criticizing the British government prior to COP26 that, okay, you have a target, but you did not tell us how, and how can I be involved from different sectors, be it financial sector, be it private sector, be it even as a stakeholder that I'll be impacted by this commitment. So I think this is an important takeaway I will personally take, even for coming from SEF, coming from you, that the discussion even in the financial institutions is focusing on the how, which is, I personally believe that that's a great acceleration of the sustainability and climate action movement.
If I could react very quickly to this.
Please.
I think the current aspirations and announcement that we are seeing on all these different commitments is necessary but not sufficient.
I agree.
And I think, but we have to get to this point where there is this willingness and recognition of how severe these issues are, but we yet to see these aspirations to translate into measurable impact. When we looked at, in particular in emerging market countries, it has not translated in measurable investment for climate investment opportunities, and that's and the criticism is warranted. And I think it's important at this stage of the process so that there is appropriate response.
Okay, I think I'm fully aligned, by the way. I wanted to say this is my last question, but I've seen another question from Omar Haysen, which is, I'm glad the audience we may need to have another session, but I think I'll wrap up with the two questions. The first one, and I'll give it to Omar Haysen. If I am an investor, where do I start to learn more about climate change investments? And then I have another question. I'll wrap it up. It's from Anonymous, but this is a question from Omar. So
is
Omar
this an investor? Is this an investor as an individual investor or representing institutional investment? There is no shortage of resources to learn about climate finance, and probably the problem is there is oversupply of this, and I think there is a need to be able to sort through sort of the advocacy discussions on climate finance versus practical applications on climate finance. We can send some relevant references for the audiences to take a look at this, but I think the best way perhaps to explore is go on climateinvestmentfunds.org, and there is quite a library start with, and then there is other sources that would be relevant depending on the nature of your investment. Is it retail investment or sort of institutional investors, and the interest of a particular sector of interest or country?
Thank you, Dr. Katya. Now, stay tuned. We'll send you some resources in the email, in addition to the website mentioned by Dr. Katya. The last question, then I'm going to wrap up. What are your thoughts on TCFD? How can it support? So for the audience, TCFD is Task Force on Climate-Related Financial Disclosures. Dr. Katya, your thoughts on TCFD?
TCFD had emerged as an important disclosure tool at the corporate level. It still doesn't exist. That framework doesn't exist at the sovereign level, like for sovereign bond issuers. It only exists for corporate issues. I think what was very important in its conception and the design of TCFD was that it was guided by TCFD as an organization, as a secretariat, but it was designed by practitioners. So it was a series of technical workshop from executive across the industry, covering all different institutions, so that the recommendations of TCFD are very practical and are targeted to the needs of the investors, so that the information that is disclosed as a part of TCFD is important. So it's still largely voluntary framework, although in the last year there had been moves by some countries making it as mandatory sometime in the future as a disclosure. So I think push for better disclosure is again necessary for us all to move forward in sort of a just transition, more climate aware investment world. The reality is it's quite a challenge for a lot of investors, and certainly a challenge from the know-how point of view of how to do this, how to measure all the different greenhouse emissions, scope 1, scope 2, scope 3, to have a meaningful impact. So it's a good start, but there's quite a lot to do both for corporates, and it needs to be introduced for sovereigns as well, which it doesn't exist.
Thank you for your valuable and thought-provoking insights, Dr. Katya. So to wrap up, I believe, in my opinion, that the call to action is clear. Do well by doing good. Although the benefits of protecting the environment was always present and visible, it was never this tangible, by the way. Businesses are being rewarded by securing investments for doing the right thing. If this is not a wake-up call, I do not know what is. So according to KPMG, 80% of the 100 companies worldwide now report on sustainability, and many of them are shifting to ESG reporting. And as Dr. Katya mentioned, this is a good start. 80% though is not good enough. All companies, I believe, that should report on sustainability and ESG. And only then we will begin to see changes, because we cannot change what we don't measure. Finally, I would like to thank our guest, Dr. Katya, and I hope you're enjoying the nice autumn in Washington, D.C. I also want to thank everyone who joined us today from Egypt. I can see some of the colleagues in Egypt, the United Arab Emirates, Jordan, US, and other countries. And I invite you all to tune in to our next session next October. Thank you so much, and stay safe.
Thank you for having me.
Thank you. Thank you, Dr. Katya.